Let's talk about the advantages of real estate investing, because I feel everyone at some point will wonder if they should buy property. So here are 5 reasons why I'd consider investing in real estate. One advantage to real estate investing is the potential for capital appreciation. Capital appreciation is just the increase in value of an asset over time. So in the case of real estate, buying property at $400,000 and being able to sell it at $550,000. What drives appreciation are factors like supply and demand, economic growth, and development in the property's area. For example, if an area experiences strong population growth due to economic opportunity, demand for housing will increase, which then leads to rising property values. Then you can project it out further. Say that same area is becoming a strong source of labor, which means you and I, and businesses and investors will take notice and inject resources into the area, bringing major transformational development with them, which will also raise property values. According to a Rocket Mortgage article, the national average appreciation rate is over 14%, which is incredible. But with that said, I want to emphasize that not all properties will appreciate at the same rate. When it comes to real estate appreciation, location, location, location. Properties located in areas with a strong local economy, think growing job market and desirable amenities, tend to appreciate more quickly than properties in areas with stagnant growth. That may seem obvious, but remember that you don't want to invest in just a good location, you want to invest in a great location. So besides factors that impact the housing market, you can also raise the value of your home directly. Properties that are well maintained and updated over time will appreciate at a rate that outpaces the property's depreciation. And keep in mind that a lot of the time, adding a new pool or remodeling your living room isn't necessary to create value. Real value is found in making sure the property is reliable and durable. Income generation, often referred to as cash flow, is probably the main advantage of real estate investing. And the way you generate income from a property is to rent it out. That rental income from your tenants is a steady stream of cash flow paid to you based on the terms of the lease. So if you're renting to a tenant on a 1-year lease that is to be paid monthly, you have both the duration and the frequency of that cash flow stream. And that cash flow looks different if you go the route of something short-term like Airbnb. Rental income can be used for whatever you want, but in general, the strategy is to cover the mortgage payments and expenses associated with the property. The money left over is the investor's profit. So not only are you paying down an outstanding mortgage with money other than your own, but you're also receiving an immediate return on investment in the form of monthly profit. This profit is what will allow you to purchase other assets and start adding to your portfolio. Rental income can also provide protection against inflation. Rent naturally increases over time along with the value of real estate and other costs of living, and has even outpaced overall inflation in the last 2 decades. That's significant when you consider that a big part of why we invest our money is to combat the decline in our dollar's purchasing power caused by inflation. Like capital appreciation, the amount of rental income generated by a property is influenced by factors such as location, property type, and the local housing market. Properties located in areas with high demand and limited supply can command higher rental rates without worrying about a lack of potential tenants. Remember that an empty investment property is a short-term liability. The most important thing about rental income is to really be sure that the property is providing positive cash flow. The rent payments you receive need to be high enough to cover your mortgage, insurance, HOA fees, maintenance, repairs, and many other smaller expenses that'll eat into your bottom line. Investing in real estate offers the advantage of substantial tax benefits that many other asset classes don't. And when thinking about the total return on an investment, tax benefits contribute to your real ROI, which is the return you earn after subtracting the costs and adding any indirect benefits of making that investment. A key tax benefit is depreciation. Depreciation is a non-cash expense that accounts for the aging of physical assets over time, and it is a real expense. Over the duration of owning your rental property, things will break. Things will require replacement. So what depreciation allows investors to do is deduct a portion of the property's value from their taxable income each year, therefore reducing the investor's total tax liability. In other words, you save on your taxes. If you're wondering how someone would even begin to quantify the rate at which a property wears down, don't worry. The IRS makes it easy with a few assumptions. The first assumption is that the expected life of a property is 27 and a half years for residential and 39 years for commercial. The second assumption is that property depreciates linearly, meaning it will depreciate by the same dollar amount every year of that property's expected life. So if it costs you $400,000 to purchase a residential property with a life expectancy of 27 and a half years, your allowable tax deduction is a little over $14,500 a year. Considering the standard deduction for single filers in 2022 was less than $13,000, 14 and a half is incredible. Another tax benefit of real estate investing is the ability to deduct expenses associated with owning and managing the property. This includes interest paid on a mortgage, property taxes, insurance premiums, travel expenses, and of course, maintenance costs. Like depreciation, these expenses are deducted from your taxable income, reducing your total tax liability even further. And we're not talking a few $100s, we're talking thousands. Property taxes alone will get you to $10,000 in most cases. Now let's talk about the 1031 exchange. At some point in an investor's journey, there will come a time where they're faced with the decision to sell their investment. And selling comes at a price. Taxes. Is it usually best to buy and hold forever? Probably, but opportunities present themselves. When selling a property, a 1031 exchange is how you can defer any taxes you'll face from the property's capital appreciation and depreciation deducted over the years. I know, the IRS taxing depreciation is disgusting. But anyways, the 1031 exchange allows an investor to sell a property and reinvest the proceeds into another property without incurring a tax liability. So you are essentially swapping a property for another, hence exchange. But the power of a 1031 lies in the fact that you're synthetically buying and holding forever, rolling the earnings of one investment into another as if the sale transaction never occurred. You can't talk about the advantages of real estate investing without talking about leverage, the double-edged sword that has both created and destroyed fortunes. Leverage can be used to finance pretty much any investment, but leverage in real estate is certainly the most common. We call them mortgages. This allows investors to purchase properties that are $250,000 or $500,000 with a relatively small amount of their own money, and finance the rest through a loan. So leverage, first and foremost, provides accessibility. Without borrowing, many of us could never afford investment properties. I certainly don't have $500,000 sitting in cash. Leverage in real estate is more accessible to the everyday investor because the property itself can guarantee the loan. Rather than coming up with collateral from other sources of wealth, the property is the collateral. And despite being in a high interest rate environment, mortgages still have some of the cheapest rates. The average 30-year mortgage rate is about 6.5%. Compare that to double-digit rates on margin loans for stocks and the double-digit rates on personal loans, and mortgages aren't looking that bad. Leverage is powerful given that it amplifies your return on investment. When calculating your ROI, all else equal, it's your net cash flow divided by your cost basis. The larger your cost basis, the lower your return for the same cash flow stream. Leverage keeps your cost basis low versus purchasing the property with cash at full price. And that makes sense. You're investing less of your own money for the same exact cash flow. In the same light, you're earning that cash flow stream by using someone else's money. And that's the key. Like I said, leverage is a double-edged sword. It may expedite wealth creation, but it also comes with significant risks. In the event the property performs poorly, whether that's losing value in a housing crash or the rent isn't high enough to cover your costs, you face a situation where you have a debt liability on a non-productive asset. No one wants to pay to lose money, so just because you can leverage your investments doesn't mean you should. Real estate investing offers the very simple but effective advantage of diversification. An investor with long-term horizons and a desire to automate most of the investing process will look to diversify their assets in the name of mitigating risks. Similar to why you would diversify a stock portfolio, a diversified asset portfolio protects your wealth from risk factors that impact a specific asset type. The fight with inflation is a great example. While the stock market entered a bear market in anticipation of the Fed raising interest rates to combat inflation, real estate was still producing high rental income that was increasing alongside inflation. In addition, the higher cost of home ownership raised the demand for rental housing, providing a stable supply of tenants. So while one asset class suffered, the other did well. That's the beauty of diversification. And if you think a single property is exposed to local market risks, you can diversify across properties too. You can invest in different cities, different property types, and different income levels. You're diversifying your real estate properties like you would diversify your stocks. Granted, it's a hell of a lot harder to diversify physical property. Not much else needs to be said on diversification, other than it's another great advantage to investing in real estate. So if you're thinking about investing in real estate, I'm right there with you. It's an attractive form of investing, and when you're weighing the pros and cons, remember why I'd consider it. Capital appreciation, income generation, tax benefits, leverage, and diversification. And that's all I have for the video. If you're thinking about investing in real estate, or have already, I'd love to hear about it. I welcome you to leave a comment down below so we could get that discussion started. As always, thanks for watching. Until next time, take care of yourself, and best of luck.